In this video, we're going to look at building revaluation. So just like land can increase in value, so can buildings. But with buildings, we've got to account for the accumulated depreciation as well. So let's have a look at Sports Limited. So Sports Limited got an independent valuation for their buildings, and the current value is at $420,000. Based on the market value of the surrounding buildings. We've got to account for the depreciation that has happened from this year. So first of all, we're going to do the depreciation. So we got our $400,000 building times by the straight line depreciation is just going to be 0.02. And so that will give us a depreciation rate amount of $8,000 that we've still got to account for. So our accumulated depreciation, so that $8,000 depreciation will go in our income statement as an expense, and we will add it to our accumulated depreciation. So we had $16,000 already in our trial balance, and now we're going to add on the next $8,000, so that'll take us to $24,000. And our new carrying amount for our buildings is going to be the $400,000 minus our new accumulated depreciation of $24,000. And then that'll give us our new carrying amount for the buildings, which is going to be $376,000. Now, to work out our building revaluation surplus, now we know what our actual carrying amount for our buildings are, we can actually work out how much of gain we've got in our market value for our buildings. So we take the $420,000 from the independent valuer, take away our new carrying amount that's adjusted for this year's depreciation and for the accumulated depreciation from other years. And so then we'll find that our buildings have increased in value by $44,000. So for the exam, you need to know how to do all of those, all of the journal entries for the transactions that we've just done. So the first one is going to be recording the depreciation for this year. So it's going to be debit depreciation on buildings for the $8,000. Credit our accumulated depreciation for our buildings. Okay, which is the $8,000. So remembering so the depreciation on buildings will go into our income statement. The accumulated depreciation on buildings will go into what we've got at the moment and help with our revaluation. Now, when we revalue our buildings, the depreciation starts from zero again. So this accumulated depreciation on the buildings is getting written off to the buildings account. So we're going to have we're going to debit accumulated depreciation on buildings, which will close that account, and then we're going to credit our buildings account, which is going to make our buildings at our carrying amount. And now we're going to record the buildings revaluation surplus. Okay, so we've got our buildings, and it's increasing to get it to the market value. We're going to increase it by $44,000, and then we've got our building revaluation surplus. Oops. And this again is another new equity account. So our accumulation of depreciation is close to zero because of the revaluation, and we're starting new. Depreciation in the future will be determined by the new valuation of the building. So in this case, for the $420,000, and the equity count building revaluation surplus is created for the unrealized gain that we have. Okay, so now we just want to look at the ledger accounts, because you could be asked to do ledger accounts. So we're going to have our balance in our building account, which is going to be the 400,000, which is what it was. Debit balance because it's an asset. And then we've got the transactions that happen on the 31st of March. First one we've got is writing off the accumulated depreciation. Okay, so we're closing that off to the buildings account. And so it's going to be a credit in our buildings account of the 24,000. So reducing the buildings account to the carrying amount of 376,000. Still in debit. And now we're going to bring in the revaluation. Which will be an increase of 44,000, and it will take our buildings account to the 420,000, which is the new revaluation. Our buildings revaluation surplus account is going to be building, and of course it's going to be a credit in here because it's an equity account. And if we'd had other revaluations, this would already have a balance, but we don't. We just have our new one. And remember, this gain is going to be recorded in our income statement under comprehensive income. In our accumulated depreciation account, we'll have the balance, which was the original 16,000, and it'll be credit. And then we're going to have the depreciation for this year coming through, which is the 8,000, taking us to the 24,000 credit. And then we're going to have our transfer of it to the building account, and it's going to be a debit. And then this takes our accumulated depreciation account to 0, and it will start new with the new revaluation. And the last thing we have to record is the depreciation. So we're going to have the accumulated depreciation for this year. For buildings, and it is going to be a debit of 8,000, and debit balance, not a credit balance. And then of course depreciation is an expense, and it gets closed off on balance day to the income summary account. And so it is at 0. So all our income and expenses get closed off to the income summary account. Sorry, got the wrong name there. At the end of the year. So the only balances that are still in our accounts at the end of the year are for our assets, our liabilities, and our equity. And now we have 4 different equity accounts. We've got contributed equity, where we record all our shareholder transactions, so all the increases and decreases in shares. Retained earnings, which is where we put our profit and we show the interim and final dividends coming out. So this is where we share our dividends, share our profit from, I should say. Then we've got the land revaluation and the building revaluation surpluses as well.